All right. So once again, thank you all so much for joining us. We really appreciate you being here. I'm going to start with some introductions. So firstly, I will introduce myself. My name is Samantha Weinberg, and I'm a senior consultant with Agendi in our San Francisco office. I have over a decade of experience working both as a consultant for Fortune 500 companies as well as in-house championing emissions reductions efforts. And I support our clients at Agendi across all aspects of their sustainability journey. But in particular, I've got expertise in preparing clients for regulatory compliance, such as the laws we're going to be talking about today, and working with them on greenhouse gas inventories and climate-related risk and opportunity assessments. My journey in CSR has included roles with the World Economic Forum, DAI, the National Human Rights Council of Morocco, and the African Presidential Center at Boston University. My co-panelist today is going to be Natalia Pasquale. Natalia is a manager at Agendi, also based in our San Francisco office, and she has a decade of consulting experience with a specialization in climate and sustainability, and has expertise in complex greenhouse gas inventories, setting and achieving climate and sustainability strategies, and analysis of climate-related financial risks and opportunities. She's worked with large organizations in over 15 different industries and has supported over 55 organizations on their sustainability journeys. So Natalia and I are going to go through the content that we've prepared and then answer questions in the Q&A section of the webinar. In addition to myself and Natalia, there are two other folks here that I want to call your attention to. The first is our colleague, Maninder Kaur. She is also from Agendi, and she will be helping to kind of manage the chat and the Q&A function throughout the webinar. So you'll be able to engage with her throughout. And then we also have a special guest here who is joining us specifically for the Q&A portion today. We have Julia Waterhouse from Kirkland & Ellis. Julia is a partner at K&E in the ESG and Impact Practice Group. And so we're really excited to have her here to help us answer some questions. I know there are plenty, I'm sure, on the kind of regulatory components, some of the finer details there. And so really excited to have Julia joining us today. But really to get started, what I'd like to do is put up a poll before we get into the content. It will really help us get an understanding of who's joining us today and your familiarity with some of the content that we're going to cover. So let me pull up the first Zoom poll. All right, and I will give folks just a little bit of time to respond to give us a sense of your experience thus far with having performed a GHG inventory, as well as having worked to identify your climate-related risks and opportunities. All right, seeing some answers come in. Thank you so much for your responses already. Great. All right. I'll give folks just another couple seconds to answer. I still see some responses trickling in. Okay, I'll hit end on the poll now. And then pop up the results. I believe everyone should be able to see them now, assuming Zoom is cooperating. But a really interesting mix in terms of, level of experience so far between kind of not yet having performed a GHG inventory and having done it for at least a year, and some even having gone through an assurance process. So that's great to see. And kind of similarly, yeah, looking at the climate-related risks and opportunities of not yet having done it, and then also having done it and done a full disclosure process already. So really appreciate everyone's participation, and I'll close that poll for now. All right, so let me make sure that I've got the deck ready to go. Okay, so I want to just really, again, let everyone know what we're, oops, the deck's skipping further ahead than me. But I want to start with letting everyone know a little bit more about what we're planning to cover today. Of course, the goal is to just generally increase anyone's understanding of around the California regulations, what they might mean for your business. But in particular, we're going to be kind of looking at these three items you see here. One, kind of hopefully demystifying them a little bit. I understand that there are definitely some question marks still around the regulations, what they mean, how to effectively comply with them. So we're going to talk about that a little bit. We're also going to walk through tactical steps to take that help you prepare for compliance with these upcoming regulations, and then also hopefully give you a sense of how organizations like Agendi can support you in being prepared to comply. All right. So for those who don't know, before I get into some of the rest of the content, I do just want to give a brief introduction of Agendi and who we are as an organization. So, Agendi is a sustainability and climate strategy consulting firm, and we serve Fortune 500 organizations, and we work with over 150 clients with a global presence. We have headquarters in North America, the UK, and the EU. We are very proud to be a certified B Corp company and a CDP accredited solutions provider. We work with our clients really on a variety of services. You can see here we do a lot across the whole spectrum of sustainability, but we split our services across these five different pillars and how we think about them. The first being capacity development. This is really integrated across all of our service offerings, but we think it's really a key building block to make sure that you have a good understanding of this the kind of components of the work that you'd be doing maybe in these other four pillars that we do. The second pillar is understanding an organization's impact. So this would be looking at things like GHG inventories or biodiversity assessments. The third is strategic planning and integrated solutions. So this is working with clients on things like materiality assessments, target setting, strategy development. The fourth is on enabling action and innovation. So this is looking at things like net zero roadmaps, transition plans, carbon offset strategies. And last, but certainly not least, a kind of key piece for what we're talking about today, which is looking at reporting and disclosure. So really kind of taking all of the things you would maybe be working on in the other pillars and figuring out how to disclose them maybe in line with some of the frameworks and guidance with all the acronyms and logos you see underneath there, like CDP, TCFD, TNFD, generally all the letters of the alphabet that tend to come with working in sustainability. All right, so with that brief introduction to Agendi and who we are that you'll be talking to today, we'll be able to get a little bit more into the content itself, starting with looking at the regulations and what we've got going in terms of what's happening in California. So California has passed four different pieces of legislation that we're going to be looking at today. The first is AB 1305, or the Voluntary Carbon Markets Disclosure Act. This is kind of looking both at buying and selling in that market, but also claims related to carbon being carbon neutral or net zero. There's SB 253, or the Climate Corporate Data Accountability Act, and this is really about reporting on and getting assurance on your GHG emissions. SB 261, which is the Climate Related Financial Risk Act, and this is on disclosures around climate related financial risk reporting aligned with frameworks like TCFD. And lastly, there is SB 219, which is really just in kind of an amendment to the previous two regulations, provide some additional clarifications and updates related to those. So today we're really going to primarily be talking about these last three, and that is in part because they're part of what's called the Climate Accountability Package. AB 1305 we will talk about a little bit, and we're not covering it in depth, not because it's not important, but because it's actually already in effect. Whereas these bottom three are the ones where there are some deadlines for entities in scope that are upcoming. And so we really want to focus our discussion on that today. So digging in first to AB 1305, as I mentioned, this is, like I said, looking at voluntary carbon offsets in terms of buying and selling. The details you see here are really related to buyers and claim makers, folks making claims about net zero emissions or carbon neutrality, for example. Sellers are also in scope. We just felt like they were maybe a little less relevant to have on the slide here for you, given the audience today, but just to note that that's the case. And ultimately, the reason that this is so important is that it's really about making sure that entities that are looking at carbon offsets and are making claims around, their emissions, like being net zero or carbon neutral, are able to really back up those claims. It's an effort really to decrease greenwashing, especially in the state of California. If you're making claims in California. Um, and as I mentioned, this is already in effect. So hopefully, if this applies to you, you've already got the relevant disclosures up on your website, as this came into effect in January 1st of this year. Um, so really just want to give an overview of this. It is an important regulation. It's just not the main focus today because, as I mentioned, we're going to focus on the ones that there's still time to prepare for compliance. If you do have questions on AB 1305, please send them into the Q&A and we will work to answer them. We also support clients all the time. As I mentioned, offsetting strategy is a key thing that we do with clients. So you can also reach out to us directly if you have more questions on this in particular. All right, getting into the climate accountability package, which, like I said, is kind of the, the meat of the content for today. There are two key pieces of legislation that are part of this. The first that I'm going to talk about is SB 253, and this is the one that's really focused on your GHG emissions. And this is looking at scopes 1, 2, and 3, which is key. And my colleague Natalia will get into more of like, what does that even mean that I'm telling you it's related to all three scopes? It's about reporting those emissions, but it's also about obtaining third-party assurance of those emissions. This applies to both public and private companies in the US, which is a little unique. That's not always the case that private companies are included. And it's looking at those companies that have over $1 billion in revenue and do business in California. I know there are a lot of questions maybe on what revenue number you're meant to be using. What does it mean to do business in California? Those are yet to be totally clarified, and we'll talk a little bit more about possible definitions and where that clarification is going to come from. And then in terms of timeline, you're looking at scope 1 and 2 emissions being reported in 2026 and scope 3 by 2027. You'll notice here are some items in blue. Those are referring to updates and clarifications that really came from the SB 219 amendment. A key one there was around the timeline for Scope 3 emissions reporting. The original legislation did also reference 2027, but it was within a certain number of days from reporting your Scope 1 and 2 emissions, and that specific piece was altered slightly to change the timeline there. So there is that kind of phased in approach of starting with Scope 1 and 2 and limited assurance and eventually getting to scope 3 and assurance for scope 3 later down the line. The second component of this that I'm going to talk about is SB 261, and this is that climate-related financial risk reporting and ISSB aligned reporting, TCFD aligned reporting. There's a lot of ways to comply. The legislation explicitly mentions TCFD as well as ISSB if you are using that for another jurisdiction already. This also applies to both public and private companies. However, there is a lower revenue threshold for this. This is looking at companies with a $500 million revenue or higher that do business in California. So it is likely that a lot more companies are going to need to comply with this legislation relative to SB 253. And this is really critical because this one has kind of the first due date coming up where you need to have your compliant report on your own website by January 1 of 2026. That might feel far away, but it will come up sooner than you think. So looking kind of at the timeline here of where we've come on these legislations and kind of what's to come in the future for kind of thinking about compliance. The laws were passed back in 2023 initially. About a year later, we got that update in SB 219 to give us a little bit more clarification. We're currently here in 2025 where AB 1305 is already in effect. This is really a year where we see for organizations that will need to comply as an opportunity to prepare for SB 253, right? Start thinking about your data collection pipeline, maybe already do some calculations for your greenhouse gas inventory, and in particular, prepare and conduct a climate-related risk assessment so that you can have that compliant report going into next year. And in particular, keeping an eye out for the California Air Resources Board, which is the entity that is responsible for providing regulations and details that I know folks are looking for on how to actually respond and comply with these laws. They originally had until January 1st of this year to provide that clarification and those regulations. However, SB 219 updated that and gave them until July 1st of this year. So that is kind of a key thing that we're still waiting on in terms of some final details and clarifications, but we definitely have enough information at this point from the original legislation to be able to move forward. And then going into 2026, like I said, there's that first key deadline coming up around SB 261 and having a compliant report prepared by January 1st, in addition to your first round of disclosures on GHG emissions. And then, as you can see, there's that kind of phased in approach going forward around scope 3, um, doing your climate-related financial risk report biennially, and then adding in that additional assurance for scope 3 starting in 2030. So there's obviously a lot going on, a lot happening here, a lot to consider, but realistically, we think that this is really the key year to prepare for complying with these regulations, which is why one of the key elements of today's discussion is really going to be about those steps you take in order to comply. So as I mentioned, there are definitely still some questions outstanding around, some of the details of the law. How do you know if you're an in-scope entity? One of those key questions is, what does it mean to do business in California? That is not fully specified in the law as it currently stands. It's not specifically explained. However, this is something we're expecting to be clarified by the California Air Resources Board, or CARB, by July 1 of this year. However, there is an existing state level definition for doing business in California that we do think they will likely use as a reference for what that means. And so our guidance has really been to use this as the likely interpretation, although not the definite interpretation of doing business in California. And so to look at this to try and understand whether or not this will apply to you. So the criteria that currently are in place from the Franchise Tax Board is a business that engages in any transaction for the purpose of financial gain in California, a business that's organized or commercially domiciled here, or a business whose California sales, property, or payroll exceed the amounts shown here. So this is, like I said, an existing definition that the state of California uses in other areas. It is possible that CARB uses this. That is something we're hoping to hear from them this year, but this is what we recommend kind of looking at if you're unsure if this will apply to you, as a way to try and gauge whether or not you would be an in-scope entity. I just kind of want to highlight again, really the scope of companies that will likely be impacted and need to comply with these laws. In particular, again, calling out that SB 261, there is a lower revenue threshold, and so significantly more companies will need to comply with that regulation compared to SB 253. And as I mentioned, the California Air Resources Board is working right now to work on the final regulations, provide some additional details on things like what does it mean to do business in California. And so we really wanted to call attention to the fact that CARB is actually currently accepting feedback on this. They put this out in December of 2024, requesting feedback. This was originally slated to close, actually, I believe last week on the 14th of February, but they extended the deadline to March 21st due to the wildfires in Southern California. So there's still an opportunity to provide feedback, and we encourage folks to do so, especially if there are areas of the law that you have things you'd like more guidance on, more clarification on, or have opinions on. We also think that what CARB is asking for feedback on, they have a whole document that provides information around what they're looking for feedback on. We think that gives us clues as to what type of information we'll get clarity from them on in what they'll release by July 1 of this year. Some examples of the topics they're looking for feedback on is the definition of doing business in California, as I mentioned, looking at how they can make sure They're minimizing any duplication of efforts by entities that may be required to report in multiple jurisdictions, right? There's a complex regulatory landscape out there now related to climate-related disclosures. And so CARB is looking to better understand how to make sure they're not asking businesses to do duplicative efforts across these different jurisdictions. They're also generally just trying to understand how companies are doing this type of work voluntarily already. How are you managing assurance? How are you voluntarily reporting your emissions? How are you already reporting climate-related financial risks so that they can have a better sense of what businesses are already doing and factor that into any regulations and guidance that they release by July 1 of this year. So this is something very much to keep an eye on. Like I said, there's a lot of information already available in the legislation in order to move forward, but we do know that there's a lot more clarification that can be provided and will be provided by CARB throughout the rest of the year. The last thing I kind of want to mention on the regulatory piece is right now, obviously, there's a complex regulatory landscape, as I mentioned, related to climate-related disclosures. In the US in particular, looking at the state level, we think is pretty important going forward. This is likely where a lot of this legislation is going to be focused. At least in the short to medium term for the US, given the current context. So while California is the only state that has passed this legislation, there are a number of other states where similar legislation has been introduced or reintroduced recently that we do want to kind of call attention to, looking at New York, New Jersey, and Colorado in particular. So they're all similar to California's legislation. There are some slight differences, between them, but ultimately California kind of being the example for a number of other states in the U.S. For example, New York is quite similar, also looking at climate-related risk disclosure, whereas New Jersey and Colorado are not. They're only looking at GHG emissions, but ultimately quite similar in nature to what California already has established. And so ultimately, by preparing to comply in California, you are likely going to be well set up if any of these laws come to pass in other states where you may be operating and doing business, depending on those definitions. So this is really something that we think is important to keep an eye on, and also why kind of being ready, being well prepared to be compliant in California will kind of set you up for success, especially in the US as it comes to what this regulatory landscape can look like going forward. With that, I will now hand it over to my colleague Natalia, who's going to talk through more of those tactical steps to comply with all the things I just talked about in the regulations.
Perfect. Thank you, Samantha. So yeah, as you said, I'm going to take us through the tactical steps towards compliance specifically for SB 253 and 261. I'm going to go over 4 different topics for each of them. First is some light context to help you better understand the requirement. Second is the process that we bring our clients through. Third is an average timeline. And then fourth is some examples of those disclosures in practice. All right, so starting off with SB 253, it seemed like we actually had a really wide mix of education on greenhouse gas inventories in the audience. So I'm going to try to give the context we need to have the conversation, explain what the scopes are. So bear with me if you do already know this quite thoroughly. So as Samantha mentioned, under SB 253, companies with annual revenues above $1 billion will need to disclose on all scopes based on the Greenhouse Gas Protocol. The Greenhouse Gas Protocol is actually the framework for estimating and reporting greenhouse gas emissions, and they define the 3 scopes that we're going to be talking about. So scope 1, you can think of as direct emissions, so things like natural gas to heat your buildings or fuel that you're using in your private fleet of vehicles. Scope 2, you can think of as indirect emissions. So for example, from the purchase and use of electricity in your buildings, where the emissions aren't merely done on site, but they're a direct result of the use of electricity on site. And then scope 3 is everything else indirect upstream and downstream in your value chain. So it encompasses 15 different categories, everything from emissions from the goods and services that you purchase, your business travel, any energy use from products that you sell, or even your investments. So I'll walk you through the five-step approach for estimating emissions to remain in compliance with SB 253 that we do with our clients. The first is project kickoff. So here's where you ensure all your stakeholders, including your data owners, are engaged, they understand the process, their roles and responsibility. And ideally, you're also performing an assessment of what scope 3 categories are relevant to you. I mentioned the 15 categories. Not all of them likely are going to be relevant for each and every one of your businesses. So this means making sure that your data owners are really understanding what is in each category, what data do we already have, and is it relevant for your business? And lastly, you want to make sure that you share expectations for them and a comprehensive data collection register. So making sure you know exactly what you're going to need to kick off the next step, which is data collection. So you need to make sure you have a thorough strategy with your data owners now that you actually understand the specific pieces of information that are required. And you'll need to allow time not just to collect the data, but also fill gaps, because especially for those of you who haven't yet done this, there are going to be gaps. You're not going to have a fully comprehensive set of data likely in your first year, and that will mean you need to fill gaps through best practice estimation methodologies, using proxy data, or just generally troubleshoot any specifically challenging areas, because the goal here is to make sure that you have the most accurate information possible. We'd say that these two steps are what you can do immediately, like leaving this call. You can definitely already start these two steps. And we'll go over kind of the timeline of everything after this, but absolutely think of this as something you can take away and immediately start doing. So once you have your data, the next thing you will need to do is start undertaking the calculations. And the first part of that is assessing the quality of the data that you've received, right? This includes making sure you understand, is the data complete? Is it consistently provided in the same format? Is it accurate? Does it have any outliers, anything missing or unexpected? And so once you've performed those data quality checks, you can definitely then select the best practice emission factors based off of that data. For those of you who don't know what that is, which may be some, quickly just review that. To get a total emissions, which is often disclosed in carbon dioxide equivalents, you have two pieces of data that you need, or pieces of information. The first is the activity data that you've already now collected in phase 2. Just saying, for example, the number of gallons of gasoline that you're using in your private fleet of vehicles. And the subsequent emission factor is what you multiply this number against to get this total emissions value, which is essentially how pollutant is this activity. So in this case, for example, you're using carbon dioxide equivalents per gallon of gasoline. Ultimately, this is all that an inventory is taking your activity data, applying the appropriate emission factor to get your total emissions. So really one of the most difficult parts is getting that data and then also determining which emission factor is relevant. Great. So once you have all those things, you need to make sure that both of these are prepared for third-party validation throughout the process, not just at the end. This means make sure your data is complete, consistent, and accurate, like the first bullet, making sure that the calculations themselves are transparent and organized, and that everything is documented, which is the next step, which is developing an inventory management plan. This is such a critical document, and I've highlighted it here too. This is absolutely going to be requested by your third-party auditors as a reference document. This should be created and updated alongside your calculation process every single year. There are guidance about different templates from the EPA for this, but Agendi has our own in-house template that's also been used throughout the assurance process to make sure we're documenting everything from data inputs, data owners, assumptions, emission factors, calculation methodologies, everything. Really, the purpose is to make sure that somebody who has no familiarity with your process is able to fully understand how the calculations perform. So let's say you're the one coordinating it in year 1 or 2, and then somebody else is coordinating it in the subsequent years. You can make sure that the calculations and assumptions are consistent across year, regardless of who's performing the inventory. And then last but not least is to finalize, assure, and communicate the results. So a lot here, but essentially you'll want to perform a final quality assurance and review of your calculations on the inventory management plan. Make sure that you feel confident in the methodology and the results. Also worth noting, sometimes internal audit teams are useful here to conduct a pre-assurance to potentially flag any issues prior to beginning the third-party assurance process. And what you're sharing when you go into the third-party assurance process is really the outcomes of steps 3 and 4. We're going to be asking you for both of these documents, and then you'll be able to communicate the figures that were already assured publicly in alignment with the SB 253 requirements. Great. So now that you have an understanding of the overall process, we'll quickly talk about the timeline for each of these steps. So the overall timeline for greenhouse gas accounting is, I will say, highly dependent on things like data collection, how long that takes, any technology that you're using, the timeline for assurance. But despite that, what we've listed here is what we would consider maybe typical first-time inventory timeline. It can take anywhere between 3 and 5 months, depending on what I've just said, and also depending on the complexity of the data and the business that you have. So as you can see, it's likely you want to start as quickly as possible. And of course, as data collection processes become more integrated into your business as usual, technology is adapted, your reliable methodology has been established, you can speed this up. The process time will decrease, but in your first year, it's likely to take somewhere between 3 and 5 months. And for Agendi specifically, we support pretty much in all steps, but more heavily in steps 1 and 3 and 4. We cover step 5, including support for a third-party assurance, but we can't, of course, do the third-party assurance support if we're doing the inventory. So that's something that will need to be coordinated separately. But the lift on the team on your side will mostly be under data collection. Okay, and lastly, in this section, to quickly help you visualize what this might look like in a disclosure, I've included 2 different sample excerpts of annual sustainability reports from our clients. So on the left, you'll see a rubrics report, and this focuses on year-over-year progress visualizations, as you can see, specifically for their scope 1 and 2. And then on the right, you'll see an excerpt from the ODP Corp's sustainability report focusing on all scopes 1, 2, and 3 and the specific reduction from their base year. So there's different ways to visualize your results from the inventory as long as you have the accurate and transparent information in your report and covering all scopes that will be in alignment with SB 253. All right. So before we go into talking fully about SB 261, just want to quickly note how they're related to each other. So carbon accounting, I would say, is the crux, the foundation of so many other sustainability activities, including reporting and disclosure, to voluntary and mandatory frameworks, including target setting and reduction. You establish a baseline by doing carbon accounting exercise, and also is integrated into your climate risk and scenario analysis, like those required through the SB 261 regulation. So going into SB 261, I want to introduce you to the 2 primary frameworks that you're likely going to use to meet the disclosure requirements for SB 261. The first is what's called the TCFD framework, which stands for the Task Force on Climate-Related Financial Disclosures. It's a mouthful, so TCFD. Their initial goal was to develop a framework for companies to transparently disclose financial impact of climate. And they were very successful in doing so. The task force itself the work has been completed, but this framework that they developed has now been used as the consistent, comparable, and standardized framework and referenced by legislation like SB 261. So what the framework has done is establish since 2017 4 key thematic areas. I am going to go through them in a little bit of detail because it is important and appropriate for both of the frameworks I'm going to be talking about today, which is TCFD and ISSB. So first is governance. There's also strategy, risk management, and metrics and targets. So each of these, like I said, carry through to the other frameworks. I'll briefly describe what each of them is. Under governance, you disclose the organization's governance around climate-related risks and opportunities. Under strategy, you're disclosing the actual potential impacts of those risks and opportunities on your business, on your strategy, and on your financial planning. In risk management, you're talking about how you identify, assess, and manage those risks and opportunities. And then finally, in metrics and targets, maybe more self-explanatory, you're disclosing those metrics and targets that you're actually using to assess the risks and opportunities. So I'll go into that second framework quickly. This is about ISSB, which stands for the International Sustainability Standards Board. Not so important that you know exactly what all these acronyms stand for. I'll say in advance because there's a lot of them, but just know that this framework is also built on and leverages the work of the TCFD. It keeps the same thematic areas and is also, according to SB 261, an acceptable framework to meet the disclosure requirements. There's two distinct parts of ISSB framework, IFRS S1 and IFRS S2, another acronym for you, International Financial Reporting Standards. What you probably want to take away is that they're similar in that material information about risks and opportunities are meant to be disclosed. But the first one, S1, focuses on overall sustainability disclosures, while the second one, S2, focuses on climate-related risk disclosures and is the one that's more closely aligned with TCFD. So I'll acknowledge that there's so much more detail we can go into on both of these, but for the purposes of our time together, we'll move forward into the process that we take with our clients. And I'll say the process is also similar across both frameworks. So I'll walk you through the 5-step approach. The first step is performing the gap analysis and benchmark study. So ideally, you're gathering key stakeholders that will be involved in the process, helping understand what is the process, what is their role, and why it's important. I think that last part is really critical, helping everybody in the organization understand why this is so critical. It is absolutely a cross-functional activity. This is not an activity that can be done in a silo of a sustainability team. You are going to have to get others involved. And so really just want to emphasize how important this first step is of making sure everyone's speaking the same language and on the same page about why this matters. You'll also need to start collecting data here. So first and foremost, this really means gathering any public or private documentation that's related to either of the frameworks to understand what your current level of disclosure is. Likely you already have some sort of disclosure about this in your 10Ks, in your annual reports, in your sustainability reports as it is. We typically also perform a peer and leader benchmark to help you understand what the industry sentiment and industry maturity is. Step 2 is around stakeholder engagement. So remember the piece I was saying in number 1 about how important it is to make sure that all the stakeholders are engaged and understand why it's important. This is why. Really making sure that you're bringing your stakeholders with you on the journey is important. Obviously, first you need to figure out who you want to engage and when and the questions you're going to need their input on. But really the main purpose of this engagement is to understand the current governance structure, risk management process, how and if climate-related risk and opportunities are integrated into those two, and to get a sense from those in the organization what they're experiencing, right? What their perspective is on the risks and opportunities that the company might be facing. Third, we have scenario analysis. So this is a hefty, hefty step. This includes both physical and transition scenario analysis. And I'll quickly just describe what scenario analysis is, because if you haven't done it before, I do feel like this is kind of a black box of, scary words, not sure what this is. So I'll try my best to explain it at a high level. Essentially what it is an assessment that helps you understand how various climate change pathways, how different potential futures could affect your business over time. So for example, on the right side, I have a little chart, highly simplified, I will say. In red, we're illustrating a high emissions future where emissions continue to increase. And this might result in high exposure and financial impacts to physical hazards like flooding, like wildfires, like heat waves, sea level rise. So essentially continuing on a path path of increased physical risk. In blue, we have a low emissions future where we decrease emissions significantly. And what this results in is potentially a high transition risks for your business, right? How do you transition to low carbon economy? This may include things like carbon pricing effects, regulatory requirement effects, reputational impacts, and how prepared you, your suppliers, and your customers are for the transition. Like I said, this is a very simplified view. There's a lot of different scenarios, and we're not going to go through all the criteria that you need to develop the framework for the scenario analysis, but know that the purpose of this exercise is to just to understand what are the potential futures, draw attention to the key factors that will drive future developments. It's not a forecast, it is not a prediction, it is not a sensitivity analysis. It's really a hypothetical construct that can be really helpful for you to understand and assess your exposure to different kinds of risks. Okay. So step 4 involves taking the outcomes of the previous 3 steps, peer benchmarking, stakeholder engagement, scenario analysis, to develop a long list of risks and opportunities, prioritize them, and then actually try to understand their impact to your business. The important thing is that you're using a consistent approach to assess the business impact across all of these in a consistent way, and identify KPIs for each of them. So that metrics and targets pillar that we were talking about earlier, here is where it comes back in, and making sure that you can better track progress towards mitigation, towards adaptation to risks, as well as how to harness opportunities. And last but not least is the actual report drafting itself. This, of course, involves taking the results of all the previous steps and developing a report or index in alignment with the framework that you've selected, whether it be TCFD or ISB. At this point, it's helpful to revisit that assess gap analysis, make sure that you're meeting the required criteria. And then all of this can actually be used to then develop your near-term and long-term strategy for continued disclosure improvement. As I mentioned in greenhouse gas inventories, it's not going to be perfect the first time. And that's not the intention of the regulatory requirements either. The intention is just disclosure, right? So if there's anything you couldn't disclose or didn't have sufficient data for, that's okay. It's understanding how to move forward from there to increase your disclosure and maturity for financial reporting. Great. So similar to the last section, now that you have an understanding of the overall process, I'll quickly look at the timeline with you all. And again, the caveat is that this, of course, varies depending on the level of maturity of the organization, the extent of the scenario analysis, the availability of the data. But generally, we'd say it takes somewhere between 4 and 6 months, especially in your first time. And where we provide a lot of support is across all of it, of course, but really in 1, 3, 4, and 5, where you will be maybe helping the most is on coordinating stakeholder engagement interviews and also then reviewing, right, the results of the scenario analysis and the business impact, and also reviewing the draft reporting to make sure that it's up to internal standards before it's publicly released. Okay, so moving on to the last piece, which is just how does this actually look in practice? We've again taken a couple of excerpts from a couple of our clients to help you understand how you get from that process to an actual report. The excerpt on the left is from NASDAQ report, and it categorizes the risks across 4 different impact buckets from low to critical, and also lists the risk mitigation strategies for each of them. The excerpt on the right we chose because it's showcasing 3 distinct impact levels for opportunities as well, rather than risks, and strategies of how to harness them. I think I want to emphasize the importance of talking about both risks and opportunities, even though SB 261 is primarily focused on the risk aspect of it, because they're both equally important to your business. Okay. So in the final couple of minutes before we go open up to Q&A, I want to discuss what implementation looks like, that overall timeline that we were talking about, and how we can help support you. So we are here in February 2025, where it says now, with the first effective dates of the regulations occurring in 2026, which is about 9 to 10 months from now. That's not a ton of time, but it is definitely very, very possible to meet this requirement. So first, starting now on the greenhouse gas inventory side of things, as mentioned, we recommend starting as soon as possible to start steps 1 and 2, which is to kick off the process and start collecting data. This will allow you to then calculate and estimate emissions in the spring, potentially undergo assurance in the summer, which also is, by the way, useful for submitting for CDP responses. And I want to clarify, you don't necessarily have to have assurance this year. It is for next year, but it's always really, really useful to undergo assurance prior to it being mandated so your teams are prepared for the process going into next year. So starting now on the climate-related risk report, you can actually use the inventory results to inform the climate-related risk report, which is why we recommend starting a little bit after. It's not a requirement, but you can start your data collection and stakeholder engagement in the early summer, and then you'll be able to integrate those assured results into the scenario analysis and business impact exploration in the midsummer, and then be able to finalize and publish your report well before the January 1st deadline. As mentioned before, these timelines can be expedited if the data collection is performed quickly, if the team is able to engage quickly, if this isn't your first time going through it and you have a quite mature team. But if you're starting from zero, it is still possible to meet these requirements. So definitely want to make sure that is also something that you take away from this. Okay, as far as how to move forward, obviously acting quickly and efficiency is going to be beneficial for you. And Agenda can offer you support in these solutions quickly, just pulling up the slide that Samantha went through at the beginning. And I've bolded the ones that are specifically relevant for the California climate laws. Under capacity development, this is relevant for all legislation, right? Helping to upskill teams and leadership is something that we do really well. Under understanding impact, this is specifically talking about the SB 253 emission inventory requirement. We haven't yet talked again about AB 1305. But that's also something we can help support in ensuring documentation and communication in compliance with AB 1305 if we're helping with carbon offset strategies. And then lastly, what we just talked about, climate-related risk and opportunity reports in compliance with SB 261 under this bucket. So before I open it up to questions, I would be remiss to not talk about beyond simply complying to these laws, how we actually do see this as an opportunity for your business. So this can mean, identifying areas for increased efficiencies in your business model, like forcing yourselves to look at all of that and how to optimize. Increasing transparency across your stakeholders, taking them with you, making sure everyone has the knowledge that they need to be successful. Third, how to adapt, right? Climate-related risks, regulatory requirements are happening. So making sure that not only you and your team, but everyone in the organization can adapt appropriately. Talk about collaborating within and across industries to discover potentially innovative solutions to decarbonization. And this is something that we are seeing across, some of our more mature clients. It is a group effort. Can't do this all alone. So making sure to really emphasize the collaboration aspect of this. 5, generally improving resilience and readiness to address future risks. So not only are you adapting, but you're also increasing your resiliency and mitigation. And then last but not least, this enhances your brand as a sustainability leader or a responsible business. It helps you be more prepared for all the things that may come, but increasing your reputation by doing so. With that, I would like to pass it back to Samantha to guide us through our Q&A for the session.
Perfect. Thank you so much, Natalia. We were originally going to do a second poll right now before getting into Q&A to keep everyone engaged, but I think we actually got quite a few questions in, so I'd rather we have more time for Q&A. So I'm going to skip the poll. So our Q&A is officially going to begin. So as a reminder, my colleague Maninder is going to help kind of field those questions and organize them for us. And we are joined very graciously by Julia from Kirkland and Ellis, who is part of the ESG and Impact Practice Group. That group advises some of the world's most most sophisticated and dynamic private equity firms, corporations, and project sponsors and lenders on complex and evolving legal issues relating to ESG and climate-related regulatory requirements, investor demands, strategic opportunities, and voluntary reporting frameworks and coalitions. So Julia's practice includes ESG risk assessment, management, and mitigation with a focus on developing and evolving legal, regulatory, and market risks, and also includes policy and procedure development, due diligence, advising, and controversy mitigation with a particular focus on business and human rights. So once again, very pleased to have Julia joining us for Q&A. I will now hand it to Maninder to let us know what questions we've gotten from the attendees.
Yeah, thank you so much. We've gotten a lot of really great questions. So thank you everyone for submitting them. The first question, I believe, Samantha, this is related to when you were talking about the California legislation in relation to other regulations that have been proposed across different states like New York and Colorado. Someone mentioned, what about Illinois? I think that's referring to the climate bill that was recently proposed. The broader question is, how do you see these California regulations influencing other state regulatory requirements like we're already seeing in Illinois?
Great. I'll maybe see it, Julia. I don't know if you have thoughts on the broader regulatory landscape or Illinois specifically before I dive in.
I mean, I would say at a high level, we are seeing other states basically copying what California is trying to do in various forms. I mean, most in Illinois and in New York, the proposed bills almost mirror what California has in some of its legislation. Either like the Illinois bill requires scope 1, 2, and 3, or would require scope 1, 2, and 3 greenhouse gas emissions reporting. If an entity does business in Illinois and has above a certain revenue threshold, I believe it's 1 billion. So very similar to how the California law is laid out, and that's how the New York bills are drafted as well. So we are kind of seeing this almost copycat approach in certain states.
Yeah, and I would just kind of add to that, the only reason Illinois was not specifically mentioned in today's presentation is that it's currently actually on hold. So we were only, what we included is not necessarily comprehensive of all states considering climate disclosure regulations. We just included some of the ones that we know to be, currently active and introduced. So yeah, definitely much more happening at the state level than just the couple of states that we included today for sure.
Great. We got a lot of questions on TCFD and scenario analysis specifically. The first one is, if a company has not yet published a sustainability report, which framework is recommended, TCFD or ISSB, and what are the pros and cons of each?
What a great question. Yeah, go ahead, Natalia.
Yes, very good question. So I would say if you are starting from scratch, I would probably push you towards TCFD, as the ISSB is built off of TSFD, but does have a bit more requirements on the metrics piece, which you might not necessarily be yet prepared for in your first year aligning to the framework. And so TCFD is always a really great and comprehensive place to begin. Of course, yeah, the pros and cons are the fact that ISSB is a bit more detailed and potentially more comprehensive, and other legislation is also pointing to ISSB as the global framework, but it's all built off of the TCFD framework. So either way, you will be in compliance. But if it's your first time, I would recommend starting at the TCFD framework point.
Great. And then there were some questions around scenario analysis. The first question is scenario analysis required? And then the second question is, for scenario analysis in climate risk reporting, does it include anticipated regulatory changes? Do you have a litmus test for when those would be included?
Another great set of questions. I can maybe take a first pass at some of this. So scenario analysis itself is not explicitly referenced in SB 261, but that's because it's right now just referencing doing a report that is in line with TCFD or if you are doing this for another jurisdiction, doing it in line with ISSB, for example. So it's not going to be very prescriptive about those kind of subcomponents, but it is looking for you to do things in compliance with the overall framework. And so as Natalia outlined, that scenario analysis is a pretty key component of kind of getting the information you would need to have a disclosure that is in line with the TCFD framework.
Another question, which may be relevant to people who are operating in the EU. Someone asked if we are CSRD compliant, are we covered under these California reporting requests?
I would say, in short, yes. There's maybe a longer response given that CARB needs to provide additional clarification in the coming months on exactly how they're going to allow, I guess, cross disclosure. I don't know, Julia, if you have further insight onto that specifically, but the short answer is yes. If you're doing CSRD, you will be covering the requirements of SB 253 and SB 261.
Yeah, I think that's right. I mean, the laws have referenced regulations in other jurisdictions, and if you are producing a report that is compliant with certain regulations in other jurisdictions, then you probably should be compliant. I think that's also one of the things that CARB is looking at in its current comment process, is how to avoid the overlapping requirements such that entities don't have to be producing different reports for different jurisdictions. The idea, I think, is to try to make it a little bit easier for entities to comply with these laws and therefore produce one report that would be compliant with regulations across jurisdictions.
Great. So someone asked, based on Agendi's experience with clients to date, who or which departments tend to be the key stakeholders to engage in the climate risk assessment process?
So another great question, and maybe just our last one as we get close to the hour, but this is definitely going to be a little bit dependent on your business in terms of, you know, what departments make the most sense. But some typical ones that we see are if you have a separate risk focused team, if you have a legal team, depending on what your facility footprint is, facilities representatives, HR, and then you definitely also want folks maybe from like your business side, your strategy side, if you know, sales, if that is relevant to you. It's really just about getting kind of a holistic look at your business operations and getting a wide representation so that, you know, all factors that might be relevant to your business are incorporated into the assessment and disclosure. All right. With that, since we are right at 12, I just want to thank everyone again for coming to this session today. We really appreciate you taking the time. Please keep an eye out for an email with some materials and the recording that we'll send to everyone in the next few days. And we hope you have a lovely rest of your week. Thank you all so much.
Thank you, everybody.
Thank you.
Yeah.